we'll start with it and end with it. So then if anyone comes in late or later, they'll see it, on the back end.
Great.
So, and thank you all for being able to get away early here. The trade finance guide is a tool I've been using for different versions of it for, we'll just say, over 30 years. I'll leave it there. You can see the gray hair maybe. So it keeps evolving. It's actually done by the ITA or the commercial services. And it's a guide that talks about the different methods of payment. So anyone it's a great resource for anyone who's starting, anyone who's advising. You don't have to be an expert to use this guide. It has executive summaries, and then it goes into more detail. And then when you have even more questions from what you really want to talk about, well, we have another resource that you can use, a couple, but another one that I'll talk about during the presentation. This guide, what's unique about it, and I'll see if it's, yeah, I think they have it here. What's really, really unique about this guide is it's a collaboration between like a who's who in international trade. So it's the international bankers that we can't get a hold of that are working on Boeing deals. So they helped collaborate on this. It's the international forfeiting, groups. Virtually every method of payment that's used, including some of the supply chain, the expertise in the associations affiliated with that type of trade finance, especially this version was just updated in 22. We'll probably have to update it again as technology continues to push everything, including trade finance. But the people who work on this are people that we normally don't have access to. So in my previous life, I was a trade finance banker. We worked on supply chain deals that were 50 million plus. It was harder to work on the one-off transactions, and that's the whole point of doing seminars and some of the resources that we have, including this. So it's a really good executive summary. I have a link to it on my presentation. Heidi can share it with everyone, so you can get to it quite easily. The reason I used to carry one around with me as when I was in international banking, because it wasn't updated as frequently. It gets updated a little bit more now, just because, as we all know, things are changing. So it's just faster and faster. It's just crazy. As we all know on the call. So again, it's trade.gov report, trade finance guide, and then it just kind of goes through, the different choices and methods of payment. Like a lot of people have heard letters of credit, and so this will talk about letters of credit, the key points, what to know. A lot of people think letters of credit are going away. I don't think they ever will. They'll be around in some version because there are two types of letters of credit, and we'll talk about that in a little bit. So point is, this gives a really good kind of executive summary, quick overview, and then as you're looking, and in my opinion, it's always, so if you're an advisor, you could be advising two companies. It's happened to me many times, same industry, and they're using different methods of payment. Just is what it is. It's very, very specific to you and your company. So, this guide, when you're an advisor, I have examples of using every single one of these methods of payment or financing programs. But individually or specifically, when you're a company, you may only use 3 of them. And normally the more global you get, or the more countries you sell to, the more methods of payment that you're going to, yeah, you may have to incorporate just because of what may be happening in this, in one of the countries that you're targeting. They may have export controls or things like that. So it's a really good guide. It's good to read or review it quickly because people, again, this is in English. I've seen it over and over again where many negotiators of contracts, they make up names, but then they describe what they're looking for. And you're like, oh, you mean a documentary collection? So then all of a sudden it allows you to get, especially if you're the one, on the negotiating side, it allows you to get to the same page much more quickly. Because believe me, it's amazing some of the names that they're really creative for methods of payment that are out there. One of the most common, we'll say, jumbles is in the letter of credit space, and internationally, they don't use standby letters of credit. They use bank guarantees, just slightly different rules, but similar purpose. So in the US, we'll use standby letters of credit, and internationally, they'll use a bank guarantee. And because there are some differences, it's good to know that one kind of is a synonym for another, but also that, okay, I need to get my banker involved, and if we have to go down this path, we're going to need some credit, we're going to need our bank, and then maybe even our bank may need international banks to be able to get this done. So it takes a little bit of time. So that's probably it for, I think it's maybe good, Heidi, to just start with a presentation. And again, I'm part of and we'll go more into this. I'm part of the District Export Council. I started the trade finance and risk team. So if someone joins late and has specific questions, I am always available. We'll just set up something and go through it with that particular company or individual one-on-one. We'll just go through their specific questions. Happy to do that. So I'm going to stop sharing the trade finance guide. And while I'm getting ready to share the presentation, any questions on the trade finance guide, why it's valuable, what its purpose is, any questions? Okay, no worries. Getting paid and how to finance. Now, I helped start way early in the very first part of my career in the international division for a company. And the owner of that company was a CPA. So he was owner and CFO, but he was excited to grow the company and start down the international path. But he said, Bruce, until we get paid, that product is a gift. So if I don't get paid, you don't get paid. Now, he said that with a smile on his face, but I don't know if he was serious or not. It just scared me enough. And again, I'm new in my career to where I learned how to get paid and how to mitigate risk, because not only did I need to sell, but he never took it back. So I always took him at his word that if we got stiffed, I think I was going to lose a couple paychecks. So what it does, methods of payment and getting paid and financing internationally, and what we're going to talk about is where to get started, why it's different. Why can't you just do what you do in the US? So just some of those very basic, where do we start? And then you build on it. And you build according to whom you're speaking with, if you're helping companies out, or you build on your knowledge as a company based on where you're selling to, your product, etc. So hopefully the tools here will help you get started, or if you've already started, help you kind of push forward. That's really the goal for today. And what there's, in my humble opinion, there's no right or wrong when it comes to trade finance, methods of payment. Um, what I'll provide always are best practices. Here's kind of the best practice, and then you choose as a company, it's your company, you choose how you want to fit that in or if you want to fit it in. I'll just give you the best practice. That's all I can do. So again, the methods are the tools, and we're just going to start with the basics. There are many more tools out there, but we'll just start kind of with the basics, trade finance guide. And when you come across something unique, hopefully after today, you'll have an outlet and you can just send a quick email, or quick call, and we can go through that unique situation. Uh, I also love to incorporate financing your growth. So international is, it's not like going into a new state. If you're all of a sudden, you're going to open up, the Southwest. Maybe you have to hire someone, but you still have very similar resources that you're using that you can rely upon. International does require, especially because of the banking industry, requires you to figure out how you're going to finance that growth. And again, it's going to change. Initially, it's just going to be super simple. You'll probably just set aside a budget and say, okay, this is what we're going to use, and have domestic finance your international growth. But as it grows, all of a sudden you may want to start looking at some tools and ways to finance so that you can grow more quickly, especially if you're getting tons of inquiries. I mean, you don't want to say no because you don't have the capital. That's the worst position to be in my opinion. How to compete. Again, it's just not us in the world. Everywhere in the world, they're trying to catch up, or in some place, some would say in some technologies we've been surpassed as the U.S., but we have some incredibly phenomenal manufacturers and suppliers to manufacturers. So I know that we can compete globally, but um, many in the rest of the world, anywhere where we had an advantage, they've been working day and night to try to catch up, as we all should assume. There's some special tools for those in the capital equipment space. A lot of new business development people or people at trade shows, professionals at those shows representing companies in the capital markets, they'll be asked, do you do any international leasing or anything like that? And 99 times out of 100, they'll say no. On that one time, they may go back and ask their bank, and their banker will say, no, we don't do international leasing. There are ways to do that. There are programs. They're just called something else. So capital equipment has some of its own unique methods. And then want to make sure that we all have the resources, the non-solicitation resources to start. So you're not being sold something that is beneficial to someone in the sale, some salesperson, and it may not be right for your company. So, we want to start there wherever we can so that you're getting best practice. You're getting, here are some approaches, and then you get to choose, kind of the way it should be. We'll have questions and we'll go back to the trade finance guide at the very end. So the very, very basics and different products can come off of these different methods of payment. Like, for example, again, we've talked about the trade finance guide, but cash in advance, that can be a wire transfer, can be checks, foreign checks. The Canadians love to send checks because it takes forever to collect them, to get the money. Because the check comes here, and then the bank in the U.S. has to send it to a Canadian bank, and then the money actually gets sent via ACH or wire. So, nice way to create some float. There are bank drafts, especially we'll just say outside of Canada. Again, there's a collection piece to that, so it takes longer, and the money's not yours until it's in your account. And credit cards, there are actually really good solutions and reasons to use and accept foreign credit cards. And then there are many, many reasons not to accept foreign credit cards. Point is, no right or wrong, but those are all versions of cash in advance, or can be. The one recommendation I have, please take this and utilize it if you aren't already. Set up an account for international with a sweep. Every bank, I'm sure your bank included, will sweep from one account to another so that you don't have money sitting in an account. Once you start, and you will have to send your international your banking information, to foreign buyers. Once you start sending that, you become a little bit more of a target. Well, if you have an account that sweeps, someone gains access to that account, there's nothing in it. So set up a separate international account. That's recommendation number one. First thing I would do if I'm starting to sell in international markets, including Canada, by the way. We'll talk a little bit about documentary collections, how they've evolved. Really bank-to-bank documentary collections. When I'm a recovering international banker, was in it for almost 20 years. Back when I was in it, 90s, early 2000s, the documentary collections were really pretty predominantly done by banks, and they went from the documentation went from bank to bank, and there was a fee. That has evolved from bank to bank pretty much to using your freight forwarder, where your forwarder, he meaning your forwarder, is going to take those documents, hold them, and they will not give them to the buyer until the wire transfer has been sent. What that does is that allows the buyer to pay you as the product gets closer to the port. So you're kind of splitting the financing of the shipping time. Or you could be, as a seller, financing more of it because maybe the wire transfer comes right before the products are ready to unload. So done a little differently. Documented collections have some risk, very different than cash in advance. But as you can see, a little more fair, because now both of you are financing the shipping piece, not just the buyer. And that doesn't sound like a lot to us in the US because of our capital markets, our interest rates, which are higher than they have been. But some of these markets have, and some of these, again, if it's a small business in some of these markets, they can easily be at double-digit interest rates, and they could easily be at 18%, which again, 1.5% per month becomes material if they're prepaying and then they're waiting for a month to get their product, or a month and a half to get it to clear customs, etc. And all of a sudden, if it's $100,000, 1% of that, 1,000, 1.5, 1,500, that's right off the top. Letters of credit, as I mentioned, there's standby or documentary. We've called documentary also commercial. It's how you get paid. They aren't used as much as they used to be, in part because of the liquidity generated after the Great Recession. It just, so many different buyers in so many different parts of the world, just everyone in cash, including foreign banks. So foreign bankers were like, we'll just, I'll create the loan here. So then sellers could get the 30, 30, 30, 10 option. And when I say 30, 30, 30, 10, that's 30% down, 30% milestone payment, 30% pre-shipment, 10% when it arrives. That's awesome if you can get it. And when there's tons of liquidity in the global marketplace, it's easier to get. Much harder to get as interest rates continue to grow and as cash flow and cash becomes more and more of a challenge for foreign buyers, especially when you're going up against maybe your competition who's offering a 5-year note, 5-year financing. So that letter of credit is how you get paid, you use the documentation. It's really, really good for custom product because once you receive that letter of credit, the buyer can't cancel the order. You set it up properly, you ship, the foreign bank pays you. If there's some issue locally, financing, whatever, that is handled in the foreign market locally where it should be handled. It's out of your control. Why would you have to deal with a foreign government issue or a local issue, with the municipality, whatever it may be? Not your concern. You're building something custom for this buyer. So letters of credit are very, very fair methods of payment because the buyer's not giving you any cash. What they're doing is they're locking in that amount on their line of credit. The cash will leave when the product ships. So the money's transferring at a very fair, time frame. They're starting to come back a little bit more as interest rates are rising and cash is becoming more challenging around the world. So if someone says, yeah, we're not going to prepay, but we'll do a letter of credit. Now remember, a letter of credit is using a foreign buyer's line, not their cash. Could be using the cash, but use their line. Let's say they have tons of equipment, tons of land. They can use that as an asset to create the letter of credit and keep their cash for other purposes. So the benefit of a letter of credit for the buyer, they're not having to tap into their cash potentially. They're just going to their bank and saying, hey, we don't have any, we own this building free and clear, but we need to buy some new equipment. There's some really good stuff in the US. So we want a line, $20 million line for this building. And we're going to exchange our old machinery for new so that we can compete better. Very, very good method of payment. Starting to come back. If you have questions on it, there's a trade finance guide. And then when you get to the structuring of a letter of credit, we know companies that will help you structure. Small fee, but well worth it. Letters of credit are probably not good for orders under $100,000. But once you get 100, 200, a million, it's worth the 1,000 that you pay or 500 that you pay to help structure that and to get someone professional to work. If you have a big bank or working with a bigger bank, they have people on staff that will help you do that. But many banks, there's probably a handful of 5 banks that have those people on staff anymore. Standby letters of credit are, again, like I said, just like bank guarantees. If you get a down payment and your buyer is smart, or if I'm advising your buyer, I'm saying you need to get a standby letter of credit or bank guarantee. All that does is that allows the buyer to get their money back if you can't perform. They don't get any interest or anything, but if you can't perform, they send in the documentation that you didn't ship on time, they get their money back. So became very common during the Great Recession when US companies were actually having some challenges here and there. And they haven't really gone away. If you're buying equipment from someone, I recommend the same thing. And we can talk about that. But the standby is something that will probably always be around because it's a really good protector. There's confirmed and unconfirmed. That's very specific to letters of credit. We won't get into what that means unless someone's using a letter of credit because it'll just confuse everyone. So, but there are ways to make letters of credit even more secure, and that's kind of what that documentation has done. And then there's you can get paid right away, or you can get paid, you can even offer terms with a letter of credit. Again, just some nuance with a letter of credit that allows you to negotiate within this protected payment piece. And then open account, and again, we'll get to more of these as well. Open account is where many companies wind up who are selling or competing in the international marketplace. Some companies will insure those open account receivables, others will self-insure. And so we'll talk about best practices and cost when selling open account to foreign buyers. Okay. So with methods of payment and kind of the why, why understand these? Why not just do it cash in advance? Or why not just kind of do it how I do it in the US? Just take that model and not really worry about anything international. Couple reasons. So, first of all, when you're selling in the US, you have the US legal system behind you. We've developed really nicely. If someone doesn't pay you, you can work with any law firm. They have someone on staff. There's even, collection people. They can work you through the process for not a lot of money. You can put a lien on assets, and you can work with someone that's not at the highest level of their firm. So the costs will be reasonable. And you have that protection selling anywhere in the US. So you're kind of using the legal system. There are other methods, that people use, but the backbone is pretty much the legal system. Internationally, the backbone kind of changes because the legal system all of a sudden becomes 2, 3, 5, 10 times more expensive. And even if you get a judgment, the product may not be there in that foreign warehouse, when you go to collect it. You just have, and depending on the country, you may have an open and shut case in the US, but that judgment in a foreign country, just because you're a foreign company, may not go your way. So best practice is usually to kind of get away from the lawyers on the payment side, with methods of payment. Even escrow, those sometimes people use escrow agreements. Those aren't overly horrible, but again, you have pretty pricey lawyers coming up with that language in multiple languages, the language of the escrow. So as you look to sell internationally and the competition is there more so, and for what I highly recommend is the commercial services. So Heidi and your team can get you, in touch with commercial services. They have guides that talk about, different markets. They're updated every year, on every country. But you also could connect with the Wisconsin office, and they could send a quick email out to whatever country you're looking at. Say, what are normal methods of payment for my industry? And maybe you could even, if you wanted to get a custom report for not a lot of money, saying, okay, what does my industry look like? More than likely, it is competitive. Either the Europeans are there, or maybe now, again, the Koreans are incredibly good. And the Chinese are good. They when they have product that's maybe slightly less competitive, they'll throw in financing. So there's a couple things when you're looking at the market and how competitive it is. Not only are you looking at product, but you're looking at payment terms. We've all been we've all been young adults who have more bills than money. And what do? You buy the best you can, but maybe you get terms, right? financing. So Export-Import Bank of the United States is called the ECA, Export Credit Agency. There are 80 of them in the world. So in Canada, it's called EDC. What they do is they help companies export. So they'll take the foreign buyer risk and allow the seller in that country to sell on terms or payment terms. And sometimes those terms, if it's capital equipment, can be 1, 3, 5, 7-year financing. And if you have a really good product, $250,000, and someone has a product that's almost as good, but can basically give 3-year financing, and you want prepay or payment when it gets there, or letter of credit, it's tough to win that negotiation. If you do good, awesome, take it all day. So these ECAs, export credit agencies, people are like, what is Export-Import Bank? Well, I mean, you can almost replace Exim Bank with ECA and just think every major country has an ECA. They basically subsidize companies in their country to sell into foreign markets because everyone wants to export more. So much so where actually Exim Bank has 3 ECAs. I'm sorry, Exim Bank. China, probably shouldn't be surprised, has 3 ECAs. They do slightly different things, but they have 3. We kind of sort of actually have 2 because we have something called DFC if you're going to invest in a foreign market. So again, if you're looking to invest in a challenging market, come to, and there'll be a link here shortly. Come to the Trade Finance and Risk team, and we'll get you in touch with a group that may be able to help you out, help you protect your risks a little bit. Now, another reason to understand the different methods of payment, that are being used in these foreign markets. Number one, because it's competitive, and your competition is global now, not just U.S. You may have a competitor from Italy, one from South Korea, and one from maybe Chile. So, as you work on that, you also need to look at the foreign market you're selling into. How is it politically? What are customs? It may be just customary to even, if the terms are 30, to just pay 15 days late. Knowing that going in is probably a good thing, because then if you're comfortable with net 60, then you want to give net 45 because that equals net 60. So, what is customary? What are they normally late? And if so, how much? How many days? Do they have currency issues? Again, there's some of these countries, especially now, they can't get the currency. Like Egypt is having a tough time getting US dollars. So maybe you take payment in euro along with the US dollars. So Pakistan had some issues. There are still plenty of projects in these countries. So just because they can't get US dollars doesn't mean they can't pay you. Then what's the communication like? Can you easily communicate? Meaning, if you're selling into Mexico, you could probably get a Spanish speaker quite easily. But can you get, if you're going to Vietnam, you can probably get away with the US, but what if it's a smaller business? Does that work? China, Japan? So, how well can you communicate? And then timeliness of the communication. Are you gonna have someone that wakes up super early? My son actually supports Europe, so he wakes up at 3 a.m. Is the relationship or the sales, is this sale going to be more transactional or more partner based? Are you setting it is it to a distributor where you're going to get a partner, you're going to train them? You may want to try to give them terms. You may take credit card from them. You may do all these different things with that partner because you're hoping to work with them now until you retire and they become someone else's, relationship. Or is it transactional? A piece of equipment that's like, once they have it, and they're not going to need to replace it for 20 years. Maybe some parts here and there, but it's still this, it's $500,000 and they're not going to need another one of these for 20 years because we build stuff so well. If that's the case, those are probably different methods of payment that you need to look at. And I strongly recommend we have this happen again and again and again. When you have a distributor in a foreign market and they don't have a big balance sheet, you need to write up in your agreement that you can sell direct, but pay them a commission. Because if you're going to try to do a $1 million sale through a distributor that has a balance sheet with $20,000 of capital, no one is going to insure them. No one is going to actually take that risk. So then you're stuck taking all of the risk as a company or as an individual. And if anything goes wrong, your issue. And then we strongly recommend in the finance field, international finance field, that you probably have an informal credit policy. And those of you advising companies selling, you probably have already recommended, that they have like a credit policy internationally times 10, because it can really, really help you with the 80-20 rule. You set up how to sell, the onesie twosies or the bulk of your product. He's like, okay, here's the method of payment we're going to pick. Here's the system we're going to use. And then those orders just roll through your normal process procedure. People are really good with detail. And then the management team or leadership team, they focus on the 20% that comes in with an unusual request. Last thing you want to do is deal with every international deal and not set up a way to get as many transactions that are normal, quote unquote, we'll say normal for that country that you're selling to, try to get those through the system. There's so many people that are good at process procedure. International is all about process procedure. That's what people forget in the US. We're phenomenal at process procedure. You don't have to speak a foreign language to make sure that you're following a process procedure on, okay, I need to get a credit report. I need to evaluate it. If it's super straightforward, I'm just going to give them, $50,000 worth of credit and we're going to move forward. You don't need a foreign language for that. Don't need to know customs for that. That's what finance people all do all day, every day. But if something comes through in the credit report, whatever your process is, and it says they're coming out of bankruptcy, but it's a monster project and you guys want it, and that they're connected, and all of a sudden you get the right people involved, and maybe you find out a way to do like a letter of credit because they have some assets hidden away or whatever it may be. You find a way to do it, and you spend your time in the right spot. Okay. So some of the trusted sources available to you, if you're with a bigger bank, try to have a conversation with the trade finance banker. If you're helping companies, ask them to try to ask their banker, their normal banker, to see if there's a trade finance banker available to them. There are fewer people in this space. They're all working supply chain, but if you can get one, they're not going to sell you anything. They're going to give you some good advice and some good resources, and they'll give you good continued resources. And remember, technology is going to keep coming to all, disciplines. So once you have, this trade finance banker, there may be an electronic letter of credit that comes around someday, hopefully sooner than later. That's a very fair method of payment, something I would jump all over if I could. And it won't be costly if it's electronic. The U.S. Commercial Services team, really good. They have a group of advisors called the District Export Council. And so you're picked by the Commerce Secretary to be part of this group. You are not allowed to solicit if you're part of this, District Export Council team. So the commercial services, they're a liaison group for every embassy in the world, and then every kind of best practice related to international business. They have kind of people, they don't have to know everything. They have people or groups to refer you to or to do research at a discounted rate. There's someone, I know Heidi knows them really well. There's someone that we strongly recommend. I mean, yes, it is government, but with international, government is your friend, believe it or not. Um, we're not going to talk about domestic, but international, they do help you out of a lot of binds. And since they're already in some of these countries anyway, I mean, all you have to do is look outside and tell you, some of the best practices, for goodness sake. Export Import Bank is an ECA, export credit agency. Their role is just like every other export credit agency all over the world, increase exports and do everything the private sector won't, and hope that the company grows enough to graduate to the private sector. People don't realize that. The goal, Exim wants you to stop using them at some point. That's their goal. They consider that a success. And believe me, like they get excited. Like we actually have to, when someone stays on a little longer than they should, we have to tell Exim why, and then that's a report that gets sent to the leadership at Exim. Why someone who could go private is staying with Exim. And a lot of times it's because that company's in some really tough markets, and private insurance, they jump in and jump out too regularly. So some companies are like, yeah, we're just going to stay with Exim Bank because we enjoy our relationships in these tough markets. That's our strategic advantage. Export Tech is a phenomenal way to put in policy, procedure, best practice. Just a phenomenal program, subsidized again by taxpayers, but I think every company that goes through it usually increases significantly their exports, or they realize, no, we're not ready, and we'll do that in 3 to 5 years. We have one company privately held that increased their exports for 4 years, then wound up selling. The owner and the kids didn't want to take over the company. The owner had something happen where he's like, I'm done. And he actually got, because of going through Export Tech, he got an extra $19 million for his company, because that's how much he grew international just in 4 years. And then a specialty broker, that's me. But we're more of a fiduciary. We're not selling. This is so for the advisors or those who are already in the international space. As you start looking to self-finance or have international be self-financing, there are some amazing tools to do this. Or if you're a growth company and you're growing domestically and internationally and you want to be able to grow both, SBA has a phenomenal tool, and it's a part of the 7A program, and it's a way to create working capital to help you grow so that you can say yes to nice sized deals. It goes up to like 5 million. And then export credit insurance creates an asset that bankers will lend against. They will not lend against uninsured receivables. They'll lend against your US receivables, your US promises to pay, but they will not lend against foreign promises to pay. They can't. It's our taxpayer, if it's our bank, it's our funds. If they're being bailed out by the government, it's our taxpayer dollars. And trying to collect overseas, as we already talked about that. Now you have basically you're paying all the lawyers all the money and you aren't getting anything. So really, really good way. So for those, if you're advising someone, and again, I talk about advice as well as being a company, because some of us in here advise all day. If someone's been selling for a minute and they're like, oh yeah, I just wish I had a little more resources to grow my international. You have dead assets all over your I mean, if you're selling internationally, you have debt assets that you can potentially create and turn into lendable assets. Or so, and I also would caution people if they're going to do foreign warehousing, that's a debt asset too. So that just sits. Yours could be in a bonded warehouse, but a bank cannot lend against that. So there are ways, different ways to maybe incent someone to where to basically a broker or a dealer. Maybe they hold a little more inventory, you give them a little more time to pay. Now they're your warehouse. And now you have an asset and they have an asset. So there are creative ways to create working capital, very specific. So I just want to plant the seed. If you don't know about international working capital, some creative ways, please give us a call. That benefit, the biggest benefit, there are two huge ones. You can get up to 75% on WIP, work in progress, and raw materials if it's for export. Again, these are programs subsidizing exports. So a government agency is going to guarantee something for a bank that turns something they can't lend against into something they can. So now all of a sudden you've created, some assets. So, that you can borrow against and say yes to more projects. And then on receivables, they'll go up to 90%. So they also will lend against letters of credit, but not the commercial, the actual standby letters of credit, which are normally 1-for-1 on your balance sheet, where if you have a $100,000 letter of credit, you have to withhold $100,000 of your line. These programs will free up 75% of that. So there are very phenomenal ways for those, especially in the capital equipment space, for them to create working capital, but not just them, all spaces, to help international pay for itself. And this is an example, highly recommend kind of reviewing it. I mean, it's double. If you just look at without the SBA guarantee, you have what, spending a couple million and you have $800,000 of assets, and you can turn that into maybe, 1.6 million. So the last thing we're going to talk about here is the most aggressive space, which is open account, and kind of comparing a little bit insured and uninsured. What to use, why, what makes sense. Again, there's no right or wrong. So just if you're going to use one, kind of the tools and costs. So this slide I really, really like for advisors and companies that are kind of just getting started. These are the questions to add to start with. What risks are you willing to take to sell into these foreign markets? And this is, again, this is leadership in a company or the owner. You need to know the answers in order to pick the appropriate method of payment, as well as do, everything else, to help your company succeed. Do you know the customer? What's typical for your industry? If it's typical for your industry, to offer 90 days and you're going to be prepay in a certain country, why go to that country? You could. It's kind of like a waste of time. Maybe focus on another country that doesn't have the competition. So what's competition doing? Nature of the order that was transactional versus, something that's going to be used again and again. And politically, again, I think it's going to become more chaotic politically over time, not less. There's going to be a lot of different trade agreements and countries that decide to work with one another and maybe at the detriment to other countries. So self-insurance, what that means is kind of, you may use that with health. As a company, you put some money aside and you use those funds to pay for anything catastrophic that happens. It's the same thing. If you're selling open account, you're kind of doing it in the US. You're selling open account, and if someone's a little bit slow, you cut them off, or you start to work with them, you find out why. So you can do that internationally as well, but there are a few more tools to consider. First of all, it's probably really good to get an independent view of the company, because information is a little more opaque internationally. And so getting the credit reports, probably, credit reporting agency would be something good when you're gathering the credit application for that particular company to decide whether you're going to offer terms or not. You are also making that decision. So you go through maybe financials, whatever you go through, whatever your credit process winds up being, as a company, you are going through that. You're training people. If someone's on vacation, you need to cross train. So you do have more time, energy, resources, and personnel that will be working in the self-insurance space. But then you avoid trade credit insurance fees. So if you have a really good, I'll use some examples. So let's say you're a company selling in the US market, and you're like, you know what? My bank is only going to give me 80 cents on the dollar. I want to get 90. So I'm going to insure my US receivables. There's a good chance that you're going to be paying anywhere from 20, 15, even 10 cents per hundred, 0.1%. It's going to be, it's always based on your portfolio, but it's going to be really aggressive because it's in the US. What credit agencies do is they ensure they're a backup, but if there is a claim, they pay you, and then they're the ones that go to court and try to collect. They all have collection agencies, and so they go through the process. It's just that you get your money more quickly. So cost is always dependent on their experience in those markets. So the trade credit insurance, the cost for, let's say, Europe, now maybe anywhere from 25 to 35, a quarter of a percent to maybe a third of a percent, kind of in there. You get into some tough markets, and you could get into, as high as maybe 1%. So it's not overly expensive, and it's all dependent on your buyers. So it is a way to almost like offset everything you're doing in the self-insurance space. Someone else is doing that for you who does it all day. And because it's so competitive, the pricing's pretty aggressive. So let me show you, a little bit why. It's because Export-Import Bank internationally, their goal is to get you started, and their goal is to get you into the private sector as far as insurance is concerned. But they don't have to make a profit. In fact, that's not their goal at all. And there's no such thing as a small, an order too small. It's pay as you go. So government agency looking to increase exports. Every major country in the world has an Exim Bank. The private space is at least these. There's probably 4 or 5 others that are kind of starting to join. What they're doing is they're doing kind of, again, just bigger stuff. The minimum for all of these is anywhere from $10,000 to $25,000 just to get started. But think, if you're selling 10 million in Europe, you're going to qualify with any one of these. So the goal as you grow is to work with one of these, and you don't just have one call you use a broker to weed through who's best for you, because they're all slightly different. What is it, trade credit insurance insuring? It's protracted default is the biggest thing we see. We'll pay you, but we have cash flow issue. Can we go do a plan? And they maybe make 2 or 3 payments and then they can't anymore. Insolvency is the easiest one. If there's, I guess, if there is a foreign insolvency, you get your money super quick. It's like you show, because the foreign the insurance company, the foreign buyer's gone, so the insurance company's like, well, there's nothing really to go after, so we're just going to write this one off. But there's the political risks are more important than they ever have been. Diversion, like all of a sudden you can't sell into a market. The buyer has, the import license canceled because there's all of a sudden, there's an issue. The negotiations of the free trade agreement or the trade agreement broke down, and now we can no longer sell into those markets. Currency and convertibility is the last countries to go into, but your product may be perfect for them. You just have to really watch it. War, insurrection, civil disobedience. It's rare we see, for legitimate reasons, denials. The denials are like when something happens where someone doesn't pay their premium, or there's a dispute. Disputes are not covered, and there are ways to ensure that you have a dispute where they can't call dispute once they're late. So there are some best practices and ways to protect yourself. I went a little bit more into the trade credit insurance, mainly because many markets you compete in, especially as time goes on, you're going to have more competition. And those of you advising, so once you start going into competitive markets, whether you use trade credit insurance or you set up a self-insured, program, either way, process, procedure, maybe compare the two for costs, but see, work with someone. If with us would be great, meaning the commercial services / trade finance and risk team can kind of help you assess. But if you're trying to get into a tough market, you're going to probably be just like you are in the US, selling on maybe 30, 60, 90-day terms. The last thing I had was medium term. It's very, very, very specific to capital market. Products that, in the commercial space that are maybe $500,000, just equipment. It's the replacement to international leasing programs. And you can either do it with Exim or you can do it on the private side. But it's not a leasing program. These programs are basically leasing with a zero residual, which means at the end of their lease, quote unquote, or the loan, the product has no value. That's just how it has to kind of write down, because it's so hard to go and perfect and grab something in a foreign country, especially if it's movable. So there are ways to offer 3, 5, 7-year financing, or we hear it every day. Boeing, Caterpillar, they've been using these programs and still do for the last 40 years. They just did. I think they just sold. Boeing did a monster sale to Angola that used the long-term financing program with Exim Bank. And so they're going to have 20 years to repay to pay back, those jets or whatever they bought. So that's it for now. The rest of this has some information on my company, what we do. That's not material here as much as knowing who to work with and where to go for future questions.
All
So
right,
I
and
would
is
stop
there
sharing.
anybody that has any questions for Bruce?
No, thank you for all the information. I think it's something that we can help our clients take a look at. So thank you.
Yeah, no, my pleasure. Definitely, it's something that gets overlooked quite often. Robert, it just does, and then all of a sudden during negotiations, people are like, "Oh, wait, I want to say yes to this. How can I?" So any way we can get proactive with methods of payment, I'm happy to help because it's so much easier than trying to fight a fire.
All right, well, thank you, Bruce, for your time. We appreciate it.
Yeah.
And if anybody else has questions, you can send a message to us and we'll get your question
Yeah.
over to Bruce. So,
Perfect.
all right.
Yeah, and then Anna, please let those who didn't make it, please share the presentation and let them know about the trade finance guide. That'd be awesome.
Sure. Did you send your
Yeah, I sent it
presentation
to
to
Heidi.
Heidi?
Yep.
Okay, perfect. All right, cool. All right. Sounds